What if I told you the Pentagon can't build missiles anymore? Not because of budget cuts, not because of congressional gridlock, but because in 1979, a room full of bureaucrats made a decision to sell America's strategic silver reserves, the same silver that conducts electricity in every guided missile, fighter jet radar system, and naval destroyer, to bail out private photography companies and Wall Street traders. And here's the part that should terrify you. They never stopped selling. Right now, as you're watching this, the United States military is rationing silver like it's a third world country. Defense contractors are bidding against Tesla and Apple for the same metal that's supposed to protect our airspace. We went from owning 3.5 billion ounces of strategic silver in 1960 to less than 5 million today. That's a 99.8% collapse of a national security asset. Sound familiar? It should. Because every time you hear supply chain crisis or chip shortage, you're hearing the echo of the exact same system that sold your nation's defense capability to the highest bidder. Drop a comment right now. Where are you watching from? Because this story crosses every border, and I need to know how global this community really is. And if you're tired of the sanitized version of financial history, hit that subscribe button. This channel doesn't do propaganda. We do receipts. Let's go back to where this betrayal actually started, and I promise you, the names involved will make your blood boil. In 1792, Alexander Hamilton passed the Coinage Act, establishing silver as one of the two monetary metals backing the young republic. For 177 years, the U.S. government accumulated silver not just for currency, but for something more important: strategic reserves. By the 1940s, military planners understood what most civilians didn't. Silver wasn't just money. It was the most conductive, non-precious metal on Earth, essential for electrical systems, radar, batteries, and eventually every piece of advanced weaponry. During World War II, the Manhattan Project borrowed 14,700 tons of silver from the U.S. Treasury to wind electromagnets for uranium enrichment. They gave it back. That's how serious the government took strategic reserves back then. But in 1959, something changed. The Treasury held 3.5 billion ounces of silver. Industrial demand was rising. Photography companies, Kodak, Polaroid, Xerox, needed silver halide for film. Electronics manufacturers needed it for circuits. And Wall Street smelled profit. Silver was trading at $0.91 per ounce, but the government was legally required to sell it at $1.29 to anyone who wanted to redeem silver certificates. Sound familiar? A government asset priced below market value, with private companies lining up to arbitrage the difference? In 1963, Congress quietly repealed the Silver Purchase Act. No fanfare, no debate about national security. Just a bureaucratic decision to stop accumulating strategic reserves and start selling them off. By 1970, the Treasury was auctioning silver every week like a pawn shop. Defense contractors had to compete with jewelers. The official story? Industrial demand required modernization of reserves. The real story? The same financial engineering that turned your home into a tradable security. In 2008, had already turned your national defense into a commodity market in the 1960s. Here's the parallel that should chill you. In 1971, Nixon closed the gold window, ending metal backing for the dollar entirely. That same year, the Defense Department filed its first classified report on strategic metal dependencies. They knew. They knew that selling off silver meant future wars would be fought with borrowed materials from foreign suppliers, and they did it anyway. By 1980, silver hit $50 per ounce during the Hunt brothers speculation. The government had sold off so much that when defense contractors needed silver for the Tomahawk missile program, they had to buy it back at 40 times the price they'd sold it for 20 years earlier. Sound familiar? That's called a strategic reserve failure. It's what happens when you let financial markets price your national security. But here's where it gets darker. Because the sell-off wasn't random. It was systematic. And the people who profited weren't just on Wall Street, they were inside the Pentagon itself. In 1979, a man named Paul Volcker became chairman of the Federal Reserve. You know him as the guy who broke inflation by raising interest rates to 20%. But there's a footnote in his tenure that never made it into economics textbooks. Between 1979 and 1982, the Federal Reserve authorized something called precious metal swap facilities, classified agreements that allowed the Fed to loan strategic metals to private banks as collateral for currency stabilization operations. The official ledger shows gold swaps. The classified ledger shows silver. This wasn't a loan, it was a transfer. Defense contractors who needed silver for military systems were now competing in the open market against JP Morgan, Goldman Sachs, and foreign central banks who had borrowed U.S. strategic silver through these swap facilities. The Pentagon's own suppliers were bidding against the Fed's counterparties. Here's the kicker. These swaps were never fully unwound. The silver never came back. When congressional investigators asked about it in 1985, they were told the records were classified for national security reasons. Let that sink in. The liquidation of a strategic reserve was classified to protect national security, not the reserve itself, the liquidation. By 1990, the U.S. strategic silver stockpile had collapsed from 3.5 billion ounces to 140 million. The Defense National Stockpile Center, the agency responsible for holding strategic materials, was selling 15 million ounces per year just to cover its own operating budget. The watchdog was eating the hoard, and the man who oversaw this entire liquidation, his name was Richard Darman, director of the Office of Management and Budget under George H.W. Bush. Before that, he was an investment banker at Lehman Brothers. You won't believe the name that comes next, or the receipt that proves this wasn't just incompetence. It was a blueprint. Let me explain how this scam actually worked, because once you understand the mechanism, you'll see it everywhere. The Defense National Stockpile Center was created in 1946 with a simple mandate: hold enough raw materials to sustain the military for 3 years of war without foreign imports. By 1960, it held 3.5 billion ounces of silver, 42,000 tons of aluminum, 1.5 million tons of manganese, and dozens of other critical metals. But in 1979, Congress passed a law that changed everything. The stockpile was now legally required to be economically viable. Translation: it had to generate revenue. The Defense Department was ordered to sell excess materials and deposit the proceeds into the General Treasury Fund. Who decided what was excess? Not military strategists, not the Pentagon. A rotating committee of OMB accountants and private sector consultants, many of whom had financial ties to the very commodities firms that would benefit from the sales. Here's the financial alchemy. Silver in the stockpile was valued at its historical acquisition cost, roughly $1.29 per ounce. But market silver was trading at $10, then $20, then $50 per ounce during the 1980 spike. Every ounce sold generated an immediate budget surplus on paper, making politicians look fiscally responsible. But here's what they didn't tell you. Every ounce sold meant future defense contractors would have to buy it back at market rates, sometimes 40 times higher, and pass that cost to taxpayers through inflated weapons contracts. Between 1980 and 2005, the Defense Logistics Agency sold 2.4 billion ounces of silver. At an average price of $6 per ounce, that generated $14.4 billion in revenue for the Treasury. Politicians celebrated. But from 2006 to 2020, defense contractors spent $47 billion purchasing silver on the open market for weapon systems, a net loss of $32.6 billion to taxpayers, not counting the strategic vulnerability of depending on foreign silver mines. The largest silver producers today? Mexico, China, Peru, and Russia. 4 countries we've had trade disputes or military tensions with in the last decade. We sold our independence for a short-term budget trick. But the stockpile liquidation was just phase 1. Phase 2 was darker. In 1994, J.P. Morgan Securities received Fed approval to trade silver futures contracts, financial derivatives that let you bet on silver prices without owning physical silver. The notional value of silver derivatives exploded from $2 billion in 1995 to $93 billion by 2008. Here's where it connects to national security. When defense contractors need silver, they don't go to mines. They go to metals exchanges like COMEX. But COMEX silver isn't all physical. It's fractional reserve. The exchange holds about 30 million ounces of physical silver, but has issued claims on over 300 million ounces through futures contracts. That's 10-to-1 leverage, 10 paper claims for every physical ounce. Now imagine you're Lockheed Martin in 2019, building the F-35 fighter jet. Each plane requires 1,500 ounces of silver for avionics, radar, and electrical systems. You go to purchase 1.5 million ounces for a production run of 1,000 jets. But you're not buying from a U.S. stockpile anymore. You're bidding against Chinese solar panel manufacturers who consume 120 million ounces annually, ETF speculators holding paper silver, J.P. Morgan's proprietary trading desk, and Tesla, which needs silver for every EV battery. In February 2021, this system almost broke. The Reddit community Wall Street Bets launched a campaign to buy physical silver and expose the fractional reserve fraud. Within 72 hours, COMEX inventories dropped by 8%, premiums spiked to 40% over spot price, and defense contractors quietly filed emergency procurement requests with the Pentagon. The Defense Logistics Agency responded by issuing classified priority purchase orders, a mechanism that hadn't been used since the 1973 oil crisis. They were rationing silver to defense contractors based on weapons system urgency. A nuclear superpower was rationing the metal that powers its missiles. Let that sink in. Here's the part that should keep you awake at night. In 2010, China held 6,000 tons of silver in state reserves. By 2023, they held an estimated 30,000 tons, a 400% increase in 13 years. Over that same period, U.S. strategic silver reserves dropped from 35 million ounces, or 1,090 tons, to less than 5 million ounces, or 155 tons. China now controls 60% of global silver refining capacity. They've spent the last decade buying closed U.S. silver mines, purchasing claims on South American deposits, and cornering the supply chain for military-grade silver alloys. In 2022, the Department of Defense released a report titled Securing Defense Critical Supply Chains. Buried on page 147 is a single sentence. Current silver acquisition timelines for priority weapon systems exceed acceptable risk thresholds. Translation: we can't get enough silver fast enough to build the weapons we need. The report was classified 3 months after release. Why? Because it confirmed what analysts had been whispering for years. In an extended conflict with China, the U.S. military would run out of silver for advanced weapon systems within 18 months, while China has enough stockpiled for a decade. We didn't just sell our strategic reserve, we sold it to our most likely adversary. Here's the sickest part. The same banks that advised the government to sell the stockpile are now the market makers in silver derivatives, earning billions in trading fees while defense contractors scramble for physical metal. J.P. Morgan paid $920 million in fines in 2020 for spoofing silver markets, placing fake orders to manipulate prices. The fine was 0.8% of their annual revenue. Cost of doing business. Goldman Sachs holds a controlling stake in one of the largest COMEX silver vaults. They charge storage fees to defense contractors who need to secure long-term silver supplies, profiting from the same scarcity the government created. And the consultants who advised on stockpile sales, they now run private equity firms that invest in silver mining companies, betting on the very shortage they engineered. This is moral hazard at the nation-state level. They manufactured the crisis, profit from the crisis, and face zero accountability because the mechanisms are so complex that even congressional oversight committees don't understand the flow. So where does this leave us? Right now, in December 2025, the U.S. produces less than 900 tons of silver annually from domestic mines. We consume over 2,000 tons per year for industrial and defense use. That gap is filled by imports, most from countries we don't control. The next F-35 production run, the Virginia-class submarine program, the hypersonic missile systems that are supposed to counter China, they all depend on silver we no longer have and must purchase from markets we don't control. The system is faster now, globalized, financialized. The next supply shock won't take years to cascade. It'll take days. And when it does, the same institutions that engineered this shortage will offer to solve it with more derivatives, more leverage, more debt. This is the pattern. Privatize the gains, socialize the risks, and classify the evidence. We went from 3.5 billion ounces of strategic independence to 5 million ounces of strategic dependence in 1 generation. That's not policy failure. That's policy success for someone. The philosophical lesson here cuts deeper than silver. It's about denial on an institutional scale. Every empire tells itself it's different, that its power is permanent, that the resources it depends on will always be there. Rome believed it about grain. Britain believed it about coal. We believed it about silver. And we were wrong. The people who made these decisions aren't stupid. They're not ignorant. They knew exactly what they were doing. They chose short-term profits and budget optics over long-term security. They chose Wall Street over the Pentagon. They chose borrowed time. And now you're living with the consequences. Here's the uncomfortable truth. This video won't change policy. The same consultants will keep advising, the same banks will keep trading, the same politicians will keep selling, because the system isn't broken. It's working exactly as designed. But you can change what you do with this information. Share this video, not because it'll fix the problem, but because the first step to accountability is awareness. Tag someone who still thinks strategic reserves mean something. Send it to that friend who trusts institutional competence. And subscribe if you want more of this unfiltered breakdown, because this pattern repeats everywhere. Copper, lithium, rare earth elements, semiconductor-grade silicon, the same playbook, different commodity. Drop a comment. Are we wiser now, or just walking the same path in better suits? Because from where I'm standing, we sold our future for a quarterly earnings report. And the bill is coming due in a currency we can't print, national security itself. Thanks for watching. See you in the next one.